Most people think they know themselves until the market tests them. They walk in confidently, convinced they're ready for risk, ready for volatility, ready for the roller coaster of investing. But the market is a mirror that doesn't lie. The moment your money is on the line, your real personality shows up. Not the version you think you are, not the version you pretend to be, not the version you want to be, but the one that reacts without warning. That's why some people freeze when charts fall, while others become greedy when markets rise, and many make decisions that completely betray the image they had of themselves. You might think you're rational, patient, calm, strategic, but the market reveals your truth in seconds. This is exactly why knowing your risk profile before investing is not just important. It is the difference between becoming wealthy and losing everything to your own emotions. The irony is that beginners often believe investing is about charts, news, returns, strategies, indicators, or timing. They think success starts with choosing the right stock, or getting in at the right moment, or beating the market with some secret technique. But long before money grows or shrinks, long before analysis begins, and long before any chart moves, the real battle starts inside you. Your psychology is your first investment, and your risk profile is the blueprint that determines whether you are building a future or walking into a disaster blindfolded. Nothing else matters until this foundation is set. Investors don't blow up because the market is cruel. They blow up because they misjudge themselves. They assume they can tolerate big losses, but panic during small dips. They say they're long-term thinkers, but react emotionally to short-term noise. They talk about discipline, but sabotage their own plans. They admire aggressive returns, but can't handle aggressive volatility. And somewhere deep inside, they are constantly fighting a silent war between who they want to be and who they truly are. That internal conflict is the real enemy, not the market. Your risk profile is the truth that most people avoid because it forces you to confront your limitations, your fears, your insecurities, and your emotional tendencies. But this truth is your protection. It is the filter that stops you from taking risks you cannot emotionally survive. It is the guide that keeps you from making stupid decisions when your mind is shaking. It is the structure that prevents chaos when the market becomes unpredictable. Without it, you become a victim of your impulses. With it, you become a strategist. A simple question exposes everything. How much loss can you tolerate before your emotions take over? Not how much you think you can tolerate. Not how much you say you can tolerate. How much can you truly tolerate when the money you worked for is vanishing on your screen? That number is brutally honest, and it is the foundation of your financial identity. Most people discover their risk profile at the worst possible time, in the middle of a crash. They finally understand what kind of investor they are when they're already losing money, feeling pressure, panicking, doubting every decision, asking themselves whether they should sell, hold, or pray. Instead of learning safely, they learn painfully. And once you panic sell at the bottom, the regret stays with you long afterward. The goal is to understand your psychology before the market teaches you with consequences. Your risk profile is your emotional threshold, and that threshold determines everything. What assets you choose, how much volatility you can handle, how long you can hold, and how predictable your decisions will be under stress. It separates those who survive the market from those who surrender to it. Think about it. Two people can buy the same investment at the same time with the same amount of money, expecting the same return. But when the market drops, one person stays calm and holds, while the other panics and exits. One sees opportunity, the other sees disaster. One is built for volatility, the other is not. Their outcomes are different, even though their investments were identical. This is the power of risk profiles. They turn the same experience into completely different journeys. Some people are natural optimists who view dips as discounts. They think long-term and don't care about short-term noise. They can handle the psychological discomfort of temporary loss, because they trust the process. Others are defensive by nature. A minor drop feels like a threat. Volatility feels like danger. They overthink, overreact, and imagine the worst-case scenario. Their mind amplifies every fluctuation into a crisis. Neither personality is wrong, but both require different strategies. When you force a conservative investor into a high-risk strategy, you're placing them in an emotional storm they cannot survive. The same way forcing an aggressive investor into a slow conservative plan will make them bored, impatient, frustrated, and prone to making reckless decisions because the strategy doesn't satisfy their psychological rhythm. This mismatch destroys portfolios not because the strategy was bad, but because the investor and strategy were not compatible. There are people who chase 10x returns because they think high returns equal success, but they forget high returns come with high emotional volatility. The kind of volatility that can break your confidence, disrupt your sleep, and push you into decisions you'll regret. If your psychology can't handle that stress, the high return strategy will destroy you long before it rewards you. And then there are people who label themselves low risk, not because they truly are, but because they're afraid of making mistakes. They avoid volatility, but also avoid growth. Their real problem isn't risk, it's insecurity. They don't trust themselves enough to take action, so they hide behind the idea of safety. This is why understanding your actual risk profile requires honesty, real, uncomfortable honesty. Your risk profile isn't just about money. It's about lifestyle, responsibilities, emotional wiring, and life's circumstances. A young person with no dependents may be able to take more risk. A person supporting a family may need more stability. A person with unpredictable income must avoid volatility. A person with strong savings can afford long-term patience. Your situation shapes your profile more than any formula ever will. Your personality shapes it even more. Are you someone who checks your portfolio daily? Do market dips trigger anxiety? Do gains trigger excitement that makes you overconfident? Do you compare yourself to others? Do you chase stories because you crave the feeling of catching something before it explodes? These patterns matter because investing doesn't reward emotion. It punishes it. The problem is that people lie to themselves. They say they're comfortable with risk until risk actually appears. They say they're long-term until the short-term hurts. They say they're disciplined until discipline becomes painful. They say they're patient until patience feels like wasting time. They say they're brave until courage requires suffering. This gap between self-image and reality is where 90% of investment mistakes come from. Markets will always fluctuate. Prices will always move up and down. Crashes will always happen unexpectedly. Opportunities will always appear suddenly. Nothing in the market is stable, except the way your risk profile influences your actions. If you don't understand your profile, every fluctuation becomes emotional chaos. But when you do understand it, volatility stops feeling scary. It becomes predictable. It becomes manageable. It becomes part of the plan instead of a threat. People don't realize how much stress comes from being in the wrong strategy for their psychology. If your portfolio constantly makes you anxious, you're not in a bad investment. You're in the wrong investment for your risk profile. A portfolio should not exhaust your emotions. It should not make you panic. It should not dominate your thoughts. It should not make you feel pressured. If it does, the mismatch is psychological, not financial. A good investment is not the one that gives the highest return. A good investment is the one you can hold without losing your sanity. That is the kind of self-awareness most people never develop. They chase numbers instead of understanding their nature. They chase hype instead of understanding risk. They chase trends instead of understanding themselves. And eventually, the market pushes them into a corner where they must act emotionally. And emotional decisions are always expensive. Understanding your risk profile gives you clarity. It tells you how much to invest, how aggressively to allocate, how long to hold, and what to expect psychologically during volatility. This clarity eliminates regret. Regret comes from ignorance, from taking risks you didn't understand, from expecting outcomes that weren't aligned with your tolerance. With a clear risk profile, your expectations become realistic. You no longer feel entitled to impossible returns. You no longer feel pressured by other people's results. You no longer compare your journey to anyone else's. You stop copying strategies that don't make sense for your situation. You stop chasing extreme opportunities. You start building a portfolio that fits your life, your mind, and your goals. Some people are built for aggressive growth. They thrive in volatility. They remain calm even during painful dips. Their psychology is suited for risk. Other people are built for stability. They prefer steady returns. They prioritize security. Their psychology rejects volatility. Both can succeed if they invest according to their nature. Every investor has a pain threshold. When losses cross that threshold, panic replaces strategy. Confidence collapses. Logic becomes blurry. Fear becomes dominant. And once emotions take control, even the best plan falls apart. Your risk profile identifies that threshold before catastrophe happens. It shows you your limits so you don't push yourself into emotional breakdown. The secret to wealth is not avoiding risk. It's choosing the right amount of risk. The amount you can emotionally survive. Most investors are not defeated by the market. They are defeated by themselves. They take risks they weren't prepared for. They invest money they couldn't emotionally lose. They hold assets they don't understand. They expect returns that don't match their tolerance. They panic at predictable dips. They sell at the bottom, buy at the top, and repeat the cycle endlessly. All of this is prevented by understanding your risk profile. The moment you know who you are as an investor, everything changes. Your decisions stop being reactions. They become deliberate actions. Your emotions stop controlling you. You start controlling them. Your strategy stops shifting randomly. It becomes stable. Your expectations stop hurting you. They start guiding you. Understanding your risk profile is not about restricting you. It's about protecting you from your own impulses. It's about structuring your investments around your emotional strengths instead of exposing your weaknesses. It's about giving you a strategy you can maintain consistently. Because consistency, not aggression, builds wealth. The market is a test of emotional endurance, not intelligence. Smart people lose money because their emotions override their knowledge. Average people become wealthy because they master their own psychology. Your risk profile is the first step in mastering yourself. Without it, you walk into the financial world with no armor. With it, you walk in prepared. And once you understand it deeply, the entire world of investing opens up with clarity you never had before. Once you truly understand your risk profile, the chaos of the market begins to make sense. You stop feeling like you're fighting against something unpredictable. Instead, you finally feel aligned with your own investment path. And that alignment is what most people never experience. They enter the market like passengers, not drivers. They let fear and greed dictate their actions. They follow advice that doesn't fit them. They copy strategies designed for someone else's psychology. But when you know your risk profile, you stop being a passenger. You take control of the wheel. You choose your lane. You choose your speed. You choose your journey. This clarity makes you immune to pressure from other investors. When someone online claims they turned R's $10,000 into R's 10 lakhs, you don't feel jealous or insecure. You don't feel the urge to replicate their aggressive strategy. You don't feel FOMO because you know something most people ignore. You're not them. You don't have their stress tolerance. You don't have their financial responsibilities. You don't have their emotional wiring. Their success story has nothing to do with your life. And you realize this truth early. Instead of losing money trying to imitate them, people ruin their finances because they try to copy someone else's risk profile. They see influencers making quick profits and assume they can handle the same volatility. But when the crash comes, and it always comes, their emotions collapse. They panic, sell, regret, and lose everything they tried so hard to gain. The real tragedy is that they weren't wrong for wanting to grow their wealth. They were wrong for trying to live someone else's emotional life. Investing is deeply personal. Your risk profile is shaped by your upbringing, your fears, your traumas, your experiences with money, your failures, your wins, your responsibilities. It's shaped by the way you respond to uncertainty. It cannot be replaced or borrowed. It has to be understood and respected. And the moment you respect it, your investment decisions begin to stabilize. You stop asking, "What should I invest in?" And you start asking, "What can I emotionally sustain for the next 10 years?" That question is far more important because the market rewards survival, not excitement. Those who stay consistent win. Those who stay calm during storms win. Those who build a realistic plan win. Those who understand themselves win. Your risk profile becomes the invisible shield that protects you from the biggest threats: impulsiveness, FOMO, panic, and overconfidence. And each of these behaviors has destroyed more wealth than any recession in history. Most people blow up their accounts not because the investment was wrong, but because their behavior was wrong for the risk they took. Someone with a low-risk profile might invest in something conservative and still achieve remarkable long-term growth because they can hold through every market cycle without stress. Someone with a high-risk profile might take aggressive bets that pay off massively because they can emotionally handle the volatility. Both succeed, not because of the investment alone, but because the investment matches their inner world. The market often exposes people brutally. They think they're patient until holding becomes difficult. They think they're brave until loss becomes real. They think they're disciplined until temptation appears. They think they're rational until emotions overpower logic. Your risk profile reveals these truths before the market does. It gives you the opportunity to prepare, adjust, and choose wisely. There's also a hidden benefit: peace, real peace. When your portfolio matches your risk profile, you stop checking your investments obsessively. You stop feeling anxious. You stop feeling confused. You stop feeling guilty when something goes down. You stop blaming yourself for temporary fluctuations. You stop feeling like investing is a constant battlefield. Instead, your portfolio becomes an extension of your personality: stable, natural, aligned. And this alignment matters more than return percentages, because emotional exhaustion is one of the biggest reasons investors burn out. Wealth should give you freedom, not stress. A person whose risk profile is aligned becomes almost unshakable. When volatility hits, they don't panic. They don't get emotional. They don't abandon their plan. They don't make reckless decisions. They trust themselves because their strategy came from self-understanding, not imitation. And something magical happens when you reach this level of clarity. You become extremely hard to manipulate. You stop reacting to hype. You stop reacting to predictions. You stop reacting to price swings. You stop reacting to online noise. You stop reacting to drama. You stop reacting to other people's wins. Nothing shakes you because your strategy is rooted in your identity, not in external events. This inner strength is rare, and it's the true edge of long-term investors. It's not luck. It's not timing. It's not intelligence. It's emotional alignment, the most underrated force in finance. When you know your risk profile, you also understand the importance of balance. Risk isn't something you eliminate. It's something you manage. You learn to create a portfolio that gives you both opportunity and protection. You learn to separate your long-term investments from your short-term desires. You learn that not all money should be exposed to volatility. You learn to protect your emotional health. By setting boundaries for risk, you stop trying to swing for the fences with every investment. You stop trying to get rich overnight. You stop trying to find the perfect moment. You stop trying to impress anyone with your portfolio. You begin to appreciate the slow, steady compounding nature of real wealth. And in that process, you learn something that changes everything. Patience is not a skill. It is a personality match. When your investment strategy matches your risk tolerance, patience becomes effortless. You don't need motivational quotes. You don't need discipline hacks. You don't need to fight your emotions. You naturally stay invested because the volatility doesn't overwhelm you. This is why people who choose the right risk profile outperform people who choose the right stock. You can pick the best investment in the world, but if you sell it during a dip because it scared you, it was never the right investment for you. Meanwhile, someone else might pick an average investment but hold it long enough for it to compound massively because they were psychologically comfortable with it. The difference is not the asset. The difference is the risk profile. This is something most people only understand after losing money. They realize too late that the market doesn't reward speed. It rewards endurance. And endurance only exists when your strategy aligns with your emotional bandwidth. When they learn this after a painful experience, it becomes obvious, but you are learning it before the pain, and that is your advantage. Understanding your risk profile also helps you build realistic expectations. You stop dreaming about doubling your money in a year. You stop imagining impossible returns. You stop feeling disappointed when your portfolio grows slowly. You understand that sustainable wealth is built consistently, not aggressively. And because your expectations become realistic, you stop making desperate decisions. You stop chasing hype. You stop investing emotionally. You stop risking money you can't afford to lose. You stop trying to catch every trend. You stop believing every rumor. You stop feeling like you're missing out. You don't get attached to temporary gains or temporary losses. You see the bigger picture. This clarity also lets you separate investing from gambling. Most people gamble without realizing it. They take risks that don't match their tolerance. They pretend everything will go right. They rely on hope instead of understanding. They trust luck over logic. But when you know your risk profile, you treat investing with the seriousness it deserves. You understand where you can afford to take risk and where you must be conservative. Another powerful thing happens. You start making decisions faster, not impulsively, but decisively. When you know your risk boundaries, you don't hesitate endlessly. You don't overthink every scenario. You don't drown in analysis. You choose quickly because your decisions have structure. Your mind is calm. You trust your framework. This decisiveness becomes a superpower. Because uncertainty destroys slow decision makers. The market punishes hesitation, but it rewards clarity. Your risk profile also gives you something most investors lack: emotional consistency. While others fluctuate emotionally with every price movement, you remain steady. You remain focused. You remain controlled. You treat dips as part of the journey, not as personal attacks. You treat gains as progress, not as permission to become reckless. You begin to understand that the true goal of investing is not maximizing returns. It's maximizing peace. Money is useless if you're constantly stressed, constantly worried, constantly panicking. Wealth means nothing if it destroys your mental health. But when your investments match your risk tolerance, you build wealth without sacrificing peace. And then comes the final transformation: confidence. Not loud, arrogant confidence, quiet, unshakable confidence. The kind that doesn't need approval. The kind that doesn't need validation. The kind that doesn't collapse under pressure. The kind that doesn't break during volatility. The kind that remains steady no matter what the market does. You trust yourself. You trust your process. You trust your long-term vision. You trust your emotional framework. You trust your discipline. This confidence allows you to survive the long winters of the market, the crashes, the corrections, the uncertainties. While others panic, you endure. While others react, you remain consistent. While others abandon their plans, you stay rooted. That's why knowing your risk profile before investing is not a suggestion. It's the foundation of long-term wealth. It determines the strategies you choose, the investments you select, the volatility you accept, the mistakes you avoid, and the emotional control you maintain. It decides whether you panic when the market dips or stay calm. It decides whether you chase hype or ignore it. It decides whether you're consistent or chaotic. It decides whether you win or lose. Your financial future is not decided by the market. It's decided by you, by your ability to choose investments that match your emotional truth. If you know your risk profile, you can build wealth for decades without losing your sanity. If you ignore your risk profile, the market will expose you again and again until you finally learn the hard way. You don't need to become someone else to succeed. You don't need to adopt someone else's style. You don't need to copy anyone's strategy. You simply need to understand who you are, emotionally and financially. Because the moment you invest according to your nature, everything begins to work in your favor. The market will always test you. But if you know your risk profile, you won't break. You'll bend, adjust, adapt, but you won't collapse. You'll survive what others fear. You'll stay steady when others panic. You'll build consistently when others gamble. You'll remain patient when others become emotional. And that patience, that calm, that emotional alignment, that is where true wealth is created. In the end, investing is not a race. It's not a competition. It's not about proving anything to anyone. It's about building a future that feels right for you. And that future begins with knowing the most important truth. Not all risk is bad. Not all risk is good. Only the right risk, the risk that fits your psychology, leads to real wealth. Know your risk profile before you invest. It won't just save your money. It will save you from yourself.